Liquidity explained. Liquidity is the foundation of the inner circle trading, ICT, and smart money concepts, SMC, trading methodology. There are two types of liquidity, buy-side liquidity, BSL, and sell-side liquidity, SSL. BSL refers to the levels on the chart where short sellers have their stop losses set, while SSL refers to the levels where traders who are long have their stop losses set. These levels are typically found at highs/lows of ranges and are seen as areas where traders exit losing positions. What is buy-side liquidity, BSL? Buy-side liquidity, BSL, refers to the price levels where a large amount of pending buy orders are placed. These orders are placed by short sellers at their stop loss in order to close out their short positions. These buy stops are typically positioned above key levels, such as the highs of the previous day, week, and month. Understanding these levels are crucial, as they indicate points where significant amounts of buy orders may trigger, leading to a potential market reversal. What is sell-side liquidity, SSL? Sell-side liquidity, SSL, refers to the price levels where a large amount of pending sell orders are placed. These orders are placed by long bias traders as their stop loss in order to close out their long positions. These sell stops are typically positioned below key levels, such as the lows of the previous day, week, and month. Understanding these levels are crucial, as they indicate points where significant amounts of sell orders may trigger, leading to a potential market reversal. How to identify liquidity levels in trading. Indicator used in this image. Key levels flux charts. How to identify buy-side liquidity, BSL. To identify buy-side liquidity, BSL, levels, mark out the following levels on your chart. Swing highs. A swing high is when price makes a high and is followed by a lower high. Previous day high, PDH. PDH is important because it represents the highest price reached in the previous trading session, making it a key reference point for traders to assess market strength and potential reversal zones. Previous week high, PWH. PWH is important because it reflects the highest price level achieved during the entire week, making it a critical benchmark for identifying potential resistance, trend continuation, or reversal points in the broader market context. Previous month high, PMH. PMH is important because it marks the peak of price action over a longer time frame, serving as a significant level that can influence market sentiment and provide insight into the strength of an ongoing trend. If this level is broken or fails to hold, it could be an early sign of a market reversal. How to identify sell-side liquidity, SSL. To identify sell-side liquidity, SSL, levels, mark out the following levels on your chart. Swing lows. A swing low is when price makes a low and is followed by a higher low. Previous day low, PDL. PDL is important because it represents the lowest price reached in the previous trading session, making it a key reference point for traders to assess market strength and potential reversal zones. Previous week low, PWL. PWL is important because it reflects the lowest price level achieved during the entire week, making it a critical benchmark for identifying potential resistance, trend continuation, or reversal points in the broader market context. Previous month low, PML. PML is important because it marks the lowest area of price over a longer time frame, serving as a significant level that can influence market sentiment and provide insight into the strength of an ongoing trend. Why is liquidity important in trading? Traders who understand liquidity will be able to find areas where market makers and smart money are trying to trigger stop loss orders or hunt for liquidity. This makes it easier to strategically place your stop loss when trading, so you don't get liquidated by smart money and price action traders. Which time frames should you look for liquidity? It's important to identify liquidity on several time frames so you can have a clear picture of the market. However, if you're scalping, you only want to focus on relevant time frames for liquidity levels, such as the 30-minute or 1 hour. The time frames to use for identifying your liquidity levels should be in relation to the time frame you prefer to trade on. On this page, what is buy-side liquidity, BSL? What is sell-side liquidity, SSL? Liquidity grabs explained. Liquidity grabs are a trading concept used by price action traders, also known as SMC or ICT traders. They mark areas where buy-side or sell-side liquidity has been swept or grabbed, which could indicate a market reversal. When a liquidity level is swept, lots of open trade positions are rapidly closed due to traders placing their stop losses at those levels. To fully understand liquidity grabs, you must have a good understanding of liquidity. You can read this article if you're not sure what liquidity is and how to spot it in the markets. In this article, we will cover what liquidity grabs are, how to locate them, how to trade them, and the theory behind them. What are liquidity grabs? Liquidity grabs are areas in the market where a large number of buy or sell orders were triggered. These typically occur at key levels such as the highs and lows of the previous day, week, and month. A bullish liquidity grab indicates a large amount of buy orders were triggered and the market is likely to trend upwards. A bearish liquidity grab indicates a large amount of sell orders were triggered and the market is likely to trend downwards. How to spot a liquidity grab? The most common way to identify a liquidity grab is by looking for the following pattern. Price approaches a key level, such as the previous day's low. Then, a candle will go below the key level and quickly shoot back up. This type of candle will have a large wick and a small body, similar to the dragonfly doji candle. This large wick indicates that there's a lot of selling pressure in the market, but buyers stepped in quickly. After the candle close, we have our liquidity grab. How to find a bullish liquidity grab? To find a bullish liquidity grab, you want to watch sell-side liquidity, SSL, levels. If you're not sure how to identify these levels, read our guide on liquidity. Once price comes down to a SSL level, look for a candle to go beneath this level and shoot back up. This type of candle will have a long bottom wick and a thin candle body, similar to the dragonfly doji candle. The long wick indicates a lot of buyers stepped into the market. After this candle closes, you will have a bullish liquidity grab. You should now look for long trades in the market since SSL was swept or grabbed, meaning buyers have stepped into the market. How to find a bearish liquidity grab? To find a bearish liquidity grab, you want to watch buy-side liquidity, BSL, levels. If you're not sure how to identify these levels, read our guide on liquidity. Once price comes down to a BSL level, look for a candle to go above the level and shoot back down. This type of candle will have a long top wick and a thin candle body, similar to the gravestone doji candle. The long wick indicates a lot of sellers stepped into the market. After this candle closes, you will have a bearish liquidity grab. You should now look for short trades in the market since BSL was swept or grabbed, meaning sellers have stepped into the market. How to trade liquidity grabs? Liquidity grabs are a good indication of a market reversal. They signify a large amount of buyers or sellers stepping into the market at key levels of BSL and SSL. We can use the liquidity grabs to form a bias in the market, either bullish or bearish. If we have a bullish liquidity grab, we want to look for long trades. If we have a bearish liquidity grab, we want to look for short trades. You can combine liquidity grabs with fair value gaps, FVG, to create a simple but effective trading strategy. Long trade example. In this trade, a bullish liquidity grab is detected green circle. Thus, we will only look for long trades. Price quickly shoots up after, forming a bullish FVG. Once price retests this FVG, you can take a long entry, setting your stop loss below the FVG and taking a 1:2 risk-to-reward trade. Indicators used in this example. Liquidity grabs flux charts. Fair value gaps volumetric flux charts. Short trade example. In this trade, a bearish liquidity grab is detected red circle. Thus, we will only look for short trades. After, price shoots down, forming a bearish FVG. Once price retests this FVG, you can take a short entry, setting your stop loss above the FVG and taking a 1:2 risk-to-reward trade. Indicators used in this example. Liquidity grabs flux charts. Fair value gaps volumetric flux charts. What is the difference between a liquidity grab and a liquidity sweep? Liquidity grabs occur from one candlestick having a quick reaction at a key liquidity level. Liquidity sweeps occur when price falls below a liquidity level and comes back up. However, the liquidity sweeps can occur over several candles instead of just one like a liquidity grab. What do liquidity grabs indicate? Liquidity grabs indicate a shift in the market trend. When liquidity grabs occur, a large number of buyers or sellers stepped into the market at that point in time, hence the large candle wick. This can be a strong indication of a market reversal. What is the best time frame to trade liquidity grabs? Liquidity grabs are typically used on higher time frames, so traders can identify a bias for their trades on a lower time frame. However, liquidity grabs can also be used on smaller time frames, such as the 5 or 15 minute for scalping. On this page, what are liquidity grabs? How to spot a liquidity grab? How to find a bullish liquidity